The stock market just saw its largest single-day point drop in history, triggered by one term: reciprocal tariffs. These tariffs are now the highest they've been since the early 1800s, and they're reshaping the global economy, impacting the US dollar, stirring trade war fears, and driving market uncertainty. Headlines are even drawing comparisons to the 1929 Great Depression. Almost everything is down, except Warren Buffett's cash pile. So what are tariffs? Simply put, they're taxes on imports. The idea is to make foreign goods more expensive so people buy local. For example, if a car from China costs $25,000 and a US-made one costs $50,000, a 100% tariff would raise the cost of the Chinese car to $50,000, leveling the playing field. But the importer, not the exporting country, pays that tariff, costs that are often passed on to consumers, raising prices on everything from clothes to electronics. Tariffs aim to protect local jobs, boost government revenue, and strengthen negotiating power. But they can also backfire, big time. Other countries like China, Canada, and those in Europe are retaliating with tariffs of their own. This can spark a trade war, driving prices up, hurting businesses, and slowing economic growth. We've seen this before. In 1930, the Smoot-Hawley Tariff Act worsened the Great Depression. World trade collapsed, unemployment soared, and prices rose while demand dropped. What's more, many of the current tariffs don't even make strategic sense. Countries like Taiwan and Malaysia, who either don't compete with the US or were once funded by us, are also getting hit. That's like taxing hammers from Mexico that cost $4 just so a US hammer can compete at $8. Sure, jobs may be created, but consumers end up paying double. And tariffs aren't the magic bullet for revenue, either. In 2022, they only brought in $80 billion, just 2% of total government income. Individual income taxes raise over 27 times more. Even if we massively increased tariffs, the fallout from job losses and reduced spending would likely outweigh the benefits. Now, it's true that some countries produce goods better due to climate, geography, or resources, like avocados from Mexico or coffee from Brazil. That's the beauty of global trade. But these tariffs disrupt that balance. They may be useful in narrow, targeted ways, but broad application risks hurting everyone. Still, there's an argument to be made that this could all be part of a negotiation tactic. If short-lived, it might lead to better trade deals. But if countries stand firm, it could escalate quickly and dangerously. So what can you do? Not much about tariffs directly. But you can control how you invest. Live below your means, stay consistent, and think long-term. Market crashes often set the stage for the biggest gains. Historically, missing just the best 10 days in the market tanks your returns. That's why I keep buying, yesterday, today, and likely tomorrow. Because time in the market always beats trying to time the market.